Earlier today, Canadians received more good news on the economic front.
Today, we lowered our policy rate by a further 25 basis points to 4.5%.
That's Bank of Canada Governor Tiff Macklem at a press conference, announcing the second in what many are predicting will be a series of cuts to the bank's benchmark interest rate. Scotiabank's chief economist, Jean-François Perrault, is our guest this episode. And as always, he'll break down this latest decision for us and explain what might be on the horizon. I'm Armina Lagaya, and this is Perspectives. JF, welcome back as always.
So thank you.
So the Bank of Canada has announced, as widely expected, a quarter-point cut of its benchmark rate. Its second such move in as many months. So tell us, what's your reaction to this? What is the big takeaway?
Well, the reaction is comforting in some sense because we're expecting and hoping for a rate cut. So that's occurred. So that is, kind of in our world, an immediate sense of relief because we got that thing right at least. The impression, though, is, I do get the sense that the governor is pretty determined to cut interest rates on a consistent basis going forward. So he made that pretty clear, both in terms of his language today, but also in terms of how he's characterizing the outlook and risks around the outlook. Very much focused on effectively the need for more growth, which he can generate through lower interest rates. So he sent a pretty strong signal, I think, that more rate cuts are coming. And it's just a matter of which meeting precisely that's going to occur. So I take a lot of comfort from that. And I think Canadians should take a lot of comfort from that too.
Mm-hmm. So what do you think in your view? Because in previous announcements, they've emphasized that it's based on the data. Rate cuts are not set, but it'll be based on what we see. So what do you think gave the Bank of Canada assurance to proceed with a cut this time?
Well, there's a range of things. The governor did talk about the slowdown in growth and that once you control for population growth, because population growth has been strong, that, growth is weaker under the hood than it might appear when you look at the big aggregates. He's indicated some, I won't call it discomfort with that, but clearly some degree of concern about the pace of economic activity, even though consumption growth has been reasonably strong. So he's, flagged that as a concern, as he has in the past a little bit, but a little bit more vocally this time around. And of course, there's the inflation outcome, which ultimately matters most for the Bank of Canada. And he reiterated that he thinks inflation is going to be 2% sometime in 2025, that inflation is on a downward trajectory, even though there are risks upside and downside to inflation. But it's clear that he is much more comforted about the inflation outlook now than he was earlier this year and at the time of the last decision as well. So, kind of a two-barreled degree of comfort, if you will, on his part, which, again, we take as comforting in the sense that it does mean that he is going to cut rates further. And from our perspective, we've been anticipating that he would be cutting interest rates at the next, essentially through the next two meetings in addition to what we did today. So that all seems to be kind of coming together reasonably well at this point.
So do you think that it's relatively likely that there will be back-to-back cuts in the next two meetings, which would put it at about 4%?
I think so. The question that we have now actually is, given his tone today, so there is, when the monetary policy decision is released, there is a statement. And then occasionally, every few meetings, the monetary policy report is released as well, which comes with a press conference. So there's a kind of a pretty big range of communications products that came out with the July decision. And when you look across those things, in particular how the governor spoke during his press conference, it's pretty clear that he's on the dovish side of things. So seems to be signaling more of a concern about, say, downside risks of the outlook or perhaps weaker inflation rather than stronger inflation. And that to us is a confirmation that they are going to be going at least for the next couple of meetings. And the question we have is whether or not they limit themselves to 4 rate cuts this year, which is what would occur if you move the next couple of meetings, rather than maybe go 5. Now, we don't think they're going to go for 5, but the tone was one in which you could see people kind of listening and trying to interpret what he's saying. And I think some people actually will think of that as him signaling that maybe he needs to do a little bit more than what people have in mind at this point in time.
What are the biggest risks at this point that could actually keep inflation from going to 2% by 2025?
Yeah, there's a couple of really big ones. One obviously is, even though the labor market has been slowing, and the governor pointed that out, wage growth remains really strong in an environment where productivity growth is really weak, or actually we call it productivity growth. It's not even productivity growth, it's a decline in productivity. That is not a combination that is helpful from an inflation control perspective. If wages are rising strongly, of course, that's input cost pressure for firms, and they need to manage that and to some extent pass that on to consumers. So the wage strength is definitely a challenge. Increasingly, we're looking at things like a return of shipping tensions. The cost of shipping has increased significantly over the last several weeks, in part because of tensions in the Gulf, in part because of some conditions in the Panama Canal, and then a bit of a rebound in activity. And that's led to a very significant rebound in shipping costs, which we know going back to the pandemic can have a pretty significant impact on inflation. So that's another thing that's kind of worrisome in terms of thinking about upside risks to inflation, which would slow the pace of decline in inflation, of course, slow the pace of cutting in interest rates. And then the biggest risk, perhaps of all, and this is not something the governor of the Bank of Canada talked about at all, is the results of the U.S. election and whether or not former President Trump wins. And if he does win, what does he do? Because the vast majority, in fact, I think the entirety of his economic platform at this point is inflationary to some degree or another. And that, of course, if he were to win and say put tariffs on things or cut taxes and increase the U.S. deficit, stimulate growth, those are inflationary. That might, at the limit, boost inflation up in Canada a little bit, certainly in the U.S., but maybe in Canada as well. And if that occurs, then you've got a bit of a slower decline in inflation in Canada and the U.S. and other parts of the world, and maybe coming with that a bit of a slower decline in the pace of interest rate cuts in Canada and the U.S. and elsewhere.
I also wanted to get your thoughts on another key source of price pressure, which is housing. Obviously, we've talked before about how that's the biggest factor when it comes to inflation here in Canada. So, what's happening in Canada's housing market at this stage? And what's the potential impact of this second rate cut?
So, obviously, housing is one of, if not the most interest rate sensitive part of the economy. So we've had a first couple of rate cuts, 50 basis points of cuts, not all that large in the greater scheme of things, but of course, the signal of the path to come on that. So that should be of great comfort to people with mortgages and people in the housing market. The challenge is that the housing market is going to be a little bit slow to respond to that. We're seeing some response already, but it takes, just as it took a long time for interest rates to have an impact in terms of bringing inflation down or slowing the economy as rates went up, you're going to get a bit of a reverse of that on the way down. The lags of monetary policy are long, 18 to 24 months, and that works both ways, on the way up and on the way down. So we're not expecting a dramatic turnaround in the housing market in the short run. It's possible, but we're not expecting that. We're not seeing that so far. But we're also not expecting with that, a very significant decline in home prices, because there is this still very, very, very large supply-demand imbalance. So, the need for housing far exceeds the available stock of housing. Now, that being said, there are conditions in the markets, particularly in Toronto and Vancouver in the condo sector, where things are really quite soft. And that might lead to some decline in prices relative to where they were in 2022, which is the peak. And maybe for the next few months, we get a little bit of softness there. But it's just a matter of time before things turn around as those rate cuts kick in and people feel like they are in the right position to go out and try and buy a place. We know what's going to happen. It's just a matter of when that's going to happen.
So, as you mentioned, Tiff Macklem talked a lot about downside risks, excess supply in the economy, slack in the labor market. So I wanted to get your take on, has the balance of risk shifted? Does it look at this stage that there is still a risk of recession, or are we still on track for that soft landing?
I think we're still on track for the soft landing. The reality, as the governor indicated, population growth is a real power behind the economy, and that is still very strong. In fact, they've revised their forecast up for population growth in 2024 because things have been stronger than expected on that front. So that kind of, if you want to call it kind of human stimulus, is still out there. When we look at forecasts for the second part of the year, and this includes our own as well as theirs, there is a significant acceleration expected in the third and fourth quarter as those rate cuts take effect and people start to spend a little bit more, or a little more comfortable with the household budgets. We know, for instance, that the household savings rate in Canada is very, very high. So the most recent data we have for that is the first quarter. Savings rate was about 7%. That is much, much, much higher than history. Totally normal. Rates have been going up. The Bank of Canada has been encouraging people to save. So it's normal for that rate to go up, but it's also normal for that rate to come down when rates start to come down. So that releases a little bit of spending. It releases a bit of pent-up demand. So we expect the economy to kind of improve as we go forward, say in the second part of the year. And the governor, I think, is firmly of that view. In fact, when you look at the Bank of Canada's forecast relative to, say, our own or others, they're a little bit stronger than what we've got this year and next. I think in part because of some of these factors.
So unlike the Bank of Canada, the Federal Reserve has held steady thus far. The European Central Bank has cut in June, but decided earlier this month to hold steady. So why the different approach, and what is the impact, particularly of the US and the Canadian central banks diverging in this way?
Yeah, so that's a question that we get all the time, and the governor gets all the time as well. So, how quickly can Canada cut without the US cutting? And that was, I think, a more important question, say, a couple of months ago relative to where it is now. A couple of months ago, there was a lot of question as to whether or not the Fed would actually cut interest rates this year. When we thought they were going to cut, we thought they were going to cut in September. We thought that for a long time. But that was not at all clear a few months ago. So you had this situation where the Bank of Canada was clearly setting in place a series of cuts, which they executed on in June, followed up in July, in an environment where folks were questioning whether the Fed would cut. So, how much can the Bank of Canada cut if the Fed itself doesn't cut? We're in a world now where it seems pretty darn clear the Fed is going to be cutting in September, if not earlier. There's a meeting in July as well for the Fed. The chance they might cut, we don't think so. But it is very clear now that the Fed is going to be cutting, or at least the expectation is they're going to cut in September and maybe in once or twice more for the remainder of the year. So, there isn't going to be that much of a gap created between where Canadian rates are and where they're headed versus the same thing in the US. So that's comforting. And that means that I think the Bank of Canada will have all the flexibility it needs to cut interest rates without worrying too much about what happens to the Canadian dollar, which of course is kind of the fly in the ointment of all this thing. It's why we talk about this rate differential. If the Fed doesn't cut and the Bank of Canada cuts a lot, then that puts downward pressure on the Canadian dollar. That puts upward pressure on inflation. It limits the ability of the Bank of Canada to do what it believes is the right thing for the Canadian economy. The Fed, thankfully, I think is going to give us a bit of a helping hand on that in the coming months.
So before we wrap up here, what are the 3 key takeaways for Canadians from this announcement?
The takeaways have been pretty similar for the last little while. First is very clear that interest rates are going to come down and that you should expect those interest rates to come down as you think about your financial plan, as you think about holidays, as you think about renewing your mortgage or buying a car. There's no question that rates are on their way down. It's just a matter of how much more they go down. So I think that's really important for Canadians to understand. I wouldn't expect, though, as is the case again with the transmission mechanism, that those rate cuts are going to trigger a super rapid rebound in economic activity, because that's not how monetary policy works. It takes a bit of time to build. So I would encourage people to not be overly worried about the economy not necessarily rebounding right away as rates come down because they're expecting it to. They shouldn't expect it to. And we expect a rebound in growth to some extent, but not a kind of a crushing wave of economic activity that flows from 50 basis points or 75 basis points lower interest rates. And the third is there is still some uncertainty about where rates are going to go. I mean, we do think there'll be another 50 basis points of cuts this year, and that will continue into 2025. But that is conditioned on inflation continuing to behave. And we do worry about these upside risks of inflation. We do worry about wage growth. We do worry about shipping costs. We do worry about the impact of the U.S. election. All those things pose an upside risk of inflation. If they pose an upside risk of inflation, they pose an upside risk to the rate forecast. So as hopeful as we are that rates are going to come down, there is a possibility that they don't come down as much as we anticipate if any of those 3 things start to bite a little bit more than they have.
Thank you, JF, once again for your insights on this latest decision.
Thanks very much.
I've been speaking with Jean-François Perrault, the Chief Economist at Scotiabank. The Perspectives podcast is made by me, Armina Lagaya, Stephen Maurice, and our producer, Andrew Norton. The clip you heard in the intro was from the Bank of Canada. For a transcript of this episode, as well as other stories, insights, analysis, and thought leadership, visit our website, scotiabank.com/perspectives. We'll see you next time.